As far as then going through the columns, so column 1, your death benefit coverage, right? So that of course increases over time as we looked at and would last the rest of your life, right? You're always going to have that coverage amount to some extent. Those are the dividends that are being reinvested, column 2. Column 3, your net cash flow, that's what someone's paying in or funding into the policy. Now, that you could do that the rest of your life or until retirement. You continue to pay some money into the policy. Rarely would someone do that past retirement, and in some cases you can stop sooner. Here in this example, I showed you're funding it until you're 50 years old, right? So you see it's 0 here, 51, you're paying and contributing to your 50. If someone says, hey, I want more accumulation than that, yes, you can continue to put money in until you're in retirement, for example, or you could stop even earlier, like we talked about earlier with the flexibility you have. Hey, you can stop oftentimes as early as the 7th year with the policy, but it's going to depend on someone's situation, how long they want to keep funding it or paying into it. In this case, we look at until age 50. Column 4, then, that's what your cash value increase is growing by in every year, right? It's increasing by that certain amount. That's where in the first couple of years we see the cost or the negative aspect of a cash value life insurance policy, right? In those first couple of years, we're not getting interest that's exceeding what we're paying into it. That's where we see all that cost come out. Why is that there? Why does it exist? Is the insurance companies factoring in, hey, I have to now be on the hook for paying out your family this 55 grand plus over time. I'm not on the hook for paying that. If something happens to you month 1 into a policy, I don't owe $1,900, I owe your family $55,000. So there's going to be some form of cost or expense to that. And where do we see that? We see it in mainly the first 2, but the first 3 years of that policy. Now, if it's larger, you can even get it to just the first 2. If it's smaller, it might be the first 3 or 4, but it's going to be in those first early years. And then key point, by year 4 now, I have growth or accumulation that's exceeding what I'm paying in, which is going to progressively get larger and larger. And when I'm at age 40, hypothetically, again, this is based on the current interest rate of 5.5. It could be higher or lower at that point, but assuming it was 5.5, that interest you're getting in that policy is exceeding what you're paying into, no taxes erode. You're not getting a 1099 for that or a tax bill in that year. That's the key leverage. So someone says, hey, alternatively, I'd rather the initial cost up front, those first couple of years, than to have tax deferred and tax-free accumulation benefits the next 10, 20, 30, 40, 50 plus years, and also likely higher yield advantage or relative advantage with what Northwestern Mutual can do versus if I just sat my money in cash or savings accounts, etc. They'd rather the yield advantage and the tax advantage with a small cost up front rather than, hey, everything I earn long term has to be taxable. So utilizing these things, of course, there are other buckets we can use as well, which would speak about, there are things like Roth IRAs, which you can also get some nice tax benefits about, long-term investing, saving, but that's going to be different. That's typically going to be stuff outside of the market. So these dollars grow and accumulate here. Column 4, 5 and 6. Okay, 5 is the total amount I paid in. Column 6, the total amount that I have available. So if we look at, again, we can scroll down. When would I actually utilize money into the policy, right? I know at any point anything happens to me, my family has this coverage amount, plus that term rider if I have an extra $200,000 from that. So in the midterm, again, I probably wouldn't use this the first couple of years. There's not much there yet. But in the midterm, let's say, age 40, hey, I had an emergency. I needed some extra cash unexpectedly. This is something I have to access. It's an extra, think of it as like an extra emergency fund per se. You could always tap into or access. So you have that benefit associated with it. Oftentimes, someone would want to then more strategically leave a lot of the money sit long term because then it grows and compounds more, right? So in this example, hey, 65 in retirement, I start taking out or withdrawing or loaning out money, right? So I had 160 at that point in the policy. Again, reason that being is why is there 160? I paid in that 50 amount. That's all the growth, the earnings and interest I've gotten on it. And I only funded it until I was 50 years old. If I funded it longer, I'd probably have more like, 2, 3, 400 plus thousand potentially in the policy. But in this example, my coverage amount, I have that 250 if anything happens, and my cash value is 160. And I just show, hey, I'm taking out money, in this case, 15,000. Could be more or less than that, but withdrawing that out every single year from someone's policy, what that does, yes, it does lower your death benefit, but as you see, you still have coverage in force, and also, will lower the amount of cash value you have in the policy as you're taking money out. But even still, after taking that money out for, call it, every other year, the next 20, 30 years, right, you still have some cash left in that policy. This way you didn't have to pay taxes on it. And then your death benefit, of course, you still have some coverage for your family left over as well.
How much can you put in per year? Like, is there a max?
Good question. Yeah, there is no max on it. There's, again, very wealthy individuals will put large amounts into life insurance, oftentimes for the unique tax treatment it gives, both in the coverage and cash accumulation benefits. There's not going to be a max into the policy they can do. It's unlike other things that typically have max limits.
That's awesome. That's, like I said, that's what really sold me, especially the fact that you can stop putting money in and still accumulate cash. For me, I know if my income increases, I would definitely want to increase my contribution.
Yeah, and that's where we know, right, you just have this term rider where you can always take that, and that's how you're able to add more, because you switch some of this into more of the cash value.
Without any more underwritings.
Correct. But no, that's a key. All you do is sign a form. Don't have to get your health evaluated at all.